Okay. Can you guys see me? Audio's good. Video's good. Okay. Cool. I need to get one of those projecting lights. But I like to trade in the dark, so that's why it's always like so dark in here. I feel like when it's like super bright, it always hurts my eyes, so that's why it's always a little bit darker. But if it does get to the point where like the webcam is too dark for you guys, let me know. I can put a light behind it just to brighten it up a bit. Okay, but yeah, so the video's good, right? Audio's good. You can see me. I think we had this issue last time. I don't know why it's doing it, but it's cutting off the bottom, right? Like, can you only see my thumb, or can you see like the bottom of my hand? Okay, yeah. So I don't know why it's doing that, but um, I think from like just looking at the charts, I mean, like it includes like it includes the entire chart. So you seeing like the bottom of my from like my neck down is not as important as seeing the entire chart. So I'm not gonna sweat it right now. Um, but yeah, so I like to just start like how we always do, and just remind everybody that these sessions are always recorded. So if for whatever reason you weren't able to make it, or if you came late, or if you just want to go back and revisit one of the meetings that we got together, and just want to go over an idea, feel free, because these are up on the T3 YouTube stream under the options and play tab. Um, and so it'll be like today's will be up. Typically, it's up by like the following day, the afternoon at the latest, and then you'll see like all the other ones up there as well. So um, if you do have any questions, if you weren't able to make one of these and you have some questions about something we went over, please don't hesitate to reach out. I'm happy to help whichever way I can. I really mean that. Like it's really, no question's a bad question. It's not inconvenience, I'm happy to hear from you guys. So just want to pass that along, especially to a couple of you that may be just joining for the first time. All right. Um, so like I was saying just like a minute ago, today was I had a harder time while I was prepping yesterday, kind of consolidating my thoughts on really how I wanted to like go about like today's session, because there's so much going on, right? And um, it's so odd how it seems like every time we get together, so like every 2 weeks, it always seems to be at like some critical juncture of the market. So whether it's technical or like earnings season, right? I mean, sometimes we get together like right in the middle of earnings season. I mean, it always seems to be like it just lines up where like there's something really interesting going on. And obviously, I mean, the way last week played out, it was we already had a lot to talk about. But then I don't know if you if any of you saw it. It was basically all over like every financial news website. The they're calling it the Nasdaq whale. So SoftBank has been aggressively buying call options. I'm sure if you read like the Wall Street Journal or Barron's, Bloomberg, basically anything, every single like news outlet was like kind of talking about it. Did you guys catch that? They were saying how SoftBank has been buying like billions of dollars worth of call options. Yeah. Okay, so that's definitely, that was like something like that, I kind of wanted to like talk about, because maybe you understand the dynamics of it, maybe you don't. I mean, even I'm like a little like fuzzy with like the like the nuts and bolts. Like, I mean, I understand the concept and why things like the mechanisms and why it does, why it impacts um, trading, but like the actual like gamma hedging is definitely like further into the fundamental spectrum of options than I normally go. But I definitely want to talk about that tonight. So, I mean, I guess it's all kind of tied together because, I mean, basically what the Qs did, like this blow off move, has some maybe it was some way impacted by what SoftBank was doing, right? So I highlighted this twice actually in like the weekly videos that I did. That basically we were in this like incredibly well defined trend, right? So everything was just going swimmingly. We were just riding this great monthly trend where every time we extended, we would roll over, right? So basically, when we got to it in June, marked the top, rolled over, held the bottom, right? Repair, hit it again in July, rolled over, held the bottom, bounce, 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 and then I basically did videos um, on it was like 2 consecutive weeks. So it was last week and then it was the week before, and what I was looking at, the first of those videos was when the Qs got into the top of the trend, um, and I mean obviously it doesn't take a master chart technician to really understand that when the Qs got right here, right? So when the Qs got into this level the first time, it was like, all right, we've held this trend so many times. Like I think it makes sense to really start to lighten up, right? I mean, you respect the trend until the trend doesn't hold, right? So whether that breaks to the upside or breaks to the downside, my opinion was basically just that I want to respect the trend. So when the Qs got to the top of this trend, I was really trying to lighten up. So I was trying to roll things more aggressively, right? Take more money off the table. I was sticking with bullish trade ideas because bullish trade ideas was what was working. I mean, like even though like I was of the opinion that like tech was a little bit extended, there were still a lot of tech names that weren't extended, right? There's still a lot of like good bullish setups out there on names that hadn't really participated or weren't too parabolic, right? So there was a lot of opportunity, but I also recognized that Qs were at the top of what had been like a really consistent trend, and if they failed here, there could be pretty like substantial downside if it just respected the trend, right? I mean, like the 20-day at that point, I think was about like 13 or 14 points away. So what we were doing is like a lot of like our option positions that we had like pretty substantial gains on. We were booking, we were rolling, um, and as we kept extending, I was really trying to just, I mean, it wasn't just closing things for the sake of closing. Like I wanted to close things as they hit targets, right? And I was even maybe moving up the targets a little bit. So instead of like looking for that 100% return, I mean, I think when things got into like the mid 80s, I was starting to like get a little bit more antsy to take money, or like if I was looking for a target at like say like a technical point, it was like 27 and it was into like the 2650 area. I was thinking, okay, maybe we'll take some money. But that being said, like Joel mentioned earlier, it's like, you know, like even having been more diligent about trying to take money off, you still get caught because I mean we were still, I don't even know what, like 90% bull trades, right? I mean, just because like that's what had been working. It was like it was like impossible to make consistent money on the downside. I felt like, at least from like a swing trade perspective, you could get like a day here, you could get a day there, but from a swing trade perspective, it just like the setups were few and far between, and even like the ones that had good setups, they really had just bad follow through. I mean, like you wouldn't get like sustained good action on the downside. So a lot of our positions were bullish, right? I mean, not all of them were extended, but a lot of the positions were bullish. So as we kept going and going and going, right? It almost created like this rubber band, and then once it finally broke, and once we got back below the trend, right, it just accelerated, and then it just flushed now down through the bottom, and we went from basically threatening to like break the trend to the upside to now having potentially broken the trend to the downside. So it's like for every reaction, there's like an equal and opposite reaction, right? So we are now paying the price for this move because we extended and people chased, right? And you had like the blow off top. Now we're getting a much sharper move to the downside, which there are some parallels to what we did in June, right? I mean, we extended, then a big blow off move lower. In that case, though, we ended up holding the 20-day perfectly. This time, we absolutely just blew through the 20-day. Well, it was actually today. We blew through the 20-day after like a really massive tail. It's like a hammer reversal on Friday. Today, we blew through it, and then we got right down into the 50-day. So this is going to be real important. We have to hold the 50-day. And what I was looking at today, I don't know if, well, actually, I know most of you aren't on the VTF, and that's why I was like messing around with some of like those short-term Q options, was because we got into the 50-day, and I figured 3 days down into the 50-day, basically the first test since April. Uh, I thought that it would be significant, and I thought that it would be a good level to take a shot at. Um, so if you're wondering why I was so focused on it, this afternoon when I was talking about in the VTF, it was because we got into the 50-day, and I wanted to try some for a bounce, and I wanted to see if we get back into the trend. So it's kind of like similar to the idea that we extended higher, blow off move, and then we extended lower, blow off move to the downside. And now that we're into the 50-day, I want to see if it holds and if we can get back into the trend, right? Because from like a fundamental perspective, it's like, yeah, we probably shouldn't have gone up as much as we had, as fast as we did. But on the downside, it's kind of like the same idea. Like we probably shouldn't have come back as far as we have, as fast as we did. A lot of the fundamentals haven't really changed all that much. I mean, some maybe yes, some not so much. So definitely it's a fast tape. Like volatility has spiked, volume has spiked. So there's a lot going on. And again, I mean, I think it's a lot of has to do with the fact that we had an extension through the top of the trend. The volume accelerated, the price action accelerated, and then I mean, I don't know how else to describe it than other than to say we basically paid the price for that, right? Like the Salesforce move, the Zoom move, all of the chasing that was going on with Apple and Tesla. I mean, we basically are paying the price for it with this really like nasty reversal to the downside. Um, I, I don't think like the bull market like of the last couple months is dead. Um, there's always people that come out and proclaim, or that's it, that's the top, and I don't know if I agree with that right now. But I do think that you kind of have to view everything from the perspective that risk is higher. That instead of just being like up every single day, we might have to deal with more of these like really like sharp, like quick rally and then a drop, quick rally and drop, right? It might not be as smooth as we were accustomed to for a good portion of July and August, right? So um, I still think I still think the overall market favors like bull positions, but that doesn't mean that we're going to get back into like that scenario where it was just like 90% bull positions, because I think there's going to be some opportunity to make money on the downside even once we do bounce. Um, so I'm definitely going to try to like get like a better mix of bullish and bearish trade ideas. Like, um, it's going to be probably individual, because I don't know if there's like one specific sector that is so much worse than the others, other than maybe energy, which is absolutely atrocious. Um, but yeah, I'm definitely going to try to get like a better mix out there. I would really like to make some money on the downside, because like, I feel like the last like the last like two or three swing trade shorts have just been like I feel like you get into them and then they immediately bounce. So like it's been pretty frustrating. But I do think once we finally do bounce, and I'm hoping we bounce off this 50-day, that we might get some better entrances for either like shorts or longs, right? So once the selling exhausts, then maybe you get like a better idea of where the strength is and where like the weakness lies, right? Does that kind of make sense? Sorry, and I can get going and really start rambling on here. So if you guys have questions like while I'm talking, just fire them off because I can really kind of get going and kind of lose track of I lose track of everything we just talked about. So if something if something piques your interest or you have a question about it, yeah, yeah. I mean, I feel like when we have like major trend or reversals in the market, it's always challenging. Some people can maneuver faster than others, and I think that's maybe more a characteristic of how they trade. But I think when you're like have slightly longer time frames, that it's a little bit harder to adjust as quick, right? Like I think if you're only a day trader and your time frame is only 1 to 2 days, then a move like this over the last week is a little bit easier to like pivot real fast, right? Because your time frame is really only like a very short period to begin with, right? So once things deteriorate, you're out and then you're flipping to go short. But if you are a trader that focuses, so like a lot of our option trades are on like several weeks to sometimes even a couple months, then it's not exactly like you just don't flip a switch, right? Because the trade itself like hasn't necessarily been impacted to like the same degree. So it's like when you're looking for a 10% move in a stock, um, or when you have like when you've been in something for like several weeks and you've been riding a trend, then you're not always getting out on like the first down day or the second down day or even sometimes on the third down day because sometimes that trend hasn't changed. Sometimes it hasn't hit your it hasn't hit your stop. It hasn't hit your exit, right? So there can be a lot of there can be a lot of like factors that go into people's styles and like when you get like these major trend reversals or major reversals in the market, some people can maneuver quicker, some people maneuver slower, but that it doesn't mean that you can't make money in like different time frames, right? So what I find is that kind of what I was doing on Friday when I was talking about the VTF is like um, just I was respecting the stops on the swing trades, right? So if it's like longer term swing trades, I'm respecting the stops. If I get stopped out, okay, I'm out. I move on. If I don't, then I sit. But what I was doing most of Friday was just it was just day trading. Just visibility is low, and this is kind of something I wanted to talk about too. Is like when visibility is low, what I find works is what I call like the 2 and 2. That's like my when volatility is high, like I shift to like my 2 and 2 playbook, and that basically means like 2 days and 2 months. That's what my time frames are typically on for um, like a lot of like my trades. Like when volatility is high, I feel like those are what tends to work better for me. So meaning like 2 days is like day trades, right? So it's like I'm either holding from like after the open and I'm up for the close, or if anything, I'll hold maybe overnight looking for a continuation the next day, right? So like what a with the kind of like the cues in mind, right? I mean, like when we first rolled over on Thursday, like say you were say you bought some puts, right? Like a 2 day hold would be basically okay. We had an ugly session on Thursday. I'm expecting follow through on Friday, right? So 2 days. So it's like say you like shorted Thursday afternoon, held overnight, and then Friday when you get the follow through the downside, you're out, right? So like a 2 day time frame, but it's just a lot of like very very short term trading because the visibility is so low. Like I have maybe like a good idea of what'll happen an hour from now. I have a good idea what'll happen maybe today, or maybe if it's like a really clean move, maybe I'm thinking there's follow through tomorrow. So like 2 day time frame, right? Like visibility is low, so I'm focusing on 2 day time frame. And when I have like a 2 day time frame, I don't mind trading weeklies just because my holding period's so short. Like I don't really want to pay for all that extra time if I'm not going to utilize it, right? So plus like I'm managing them a lot closer, so I don't mind being in the weeklies because that's one of like the main things with weeklies is that you really need to manage them closely because a move against your position can really take like a toll on them pretty quick. So um, 1 to 2 day time frame, I'm looking at weekly contracts. Just lower visibility, but just trying to like snipe moves here and there, right? I'm just trying to like pick off some fast moves, lock in money, get cash flow, right? The other thing that I like to do is like 2 month time frame. So that's just like a ballpark. Not every trade is exactly 2 months, but like 2 months because that'll give an opportunity for like the volatility to smooth out, right? And you kind of get like a resumption of a trend or maybe like a bigger move. Also, implied volatility, right? When options or when the market spikes and volatility spikes, then the option pricing spikes too. And the 2 month time frame can like smooth out a lot of that high near term implied volatility. And it also allows you to kind of take advantage of maybe some like sharper moves, right? So if I'm looking for a bounce, then like a longer time frame allows you to potentially capitalize on a sustained move. Or on the opposite side, if things look like they're about to really roll over, then like 2 months might give you an opportunity to capitalize on a really sustained move to the downside, right? So like generally speaking, like when volatility increases, like I say, it's my playbook is like 2 and 2, so it's like 2 days and 2 months. Like most of my time frames on my option trades are in kind of in that category, right? This is definitely something that we've talked about in the past, but I mean it's particularly relevant right now just because of how like last week played out and how this week has already started. Um, a lot of my trades, even again today, I mean a lot of my trades were like very short term, but Zoom longer term, Kroger is basically it's basically like the equivalent of like a 2 day trade, um, just because it's like the holding period is gonna be very very short and has a catalyst coming up this week. But it's kind of like the same idea. Does that make sense? So like what I find is most challenging in this type of tape is like the mid range swing. So like 2 weeks, 3 weeks, like those can be very very challenging um, from like an option trading perspective. Uh, because the contracts are going to be expensive, implied volatility wise, and also like it's kind of tough to figure out where we're going to be a week from now, right? I mean, a month, maybe like 2 months from now, I feel like I have a pretty good idea that some of these stocks could work their way higher, but like 2 weeks from now, it seems to be like kind of like a vague time frame where I just don't have a whole lot of conviction. Like tomorrow, I think I have if a stock closed on its low, I have a pretty good idea that there's a chance that it trades lower tomorrow. 2 months from now, I feel like if a stock is at its 50 day, right? So like what was I looking at? So it's like like Square, right? So stock is at its 50 day. I feel like 2 months from now, there's a pretty good chance that Square is higher from where it is right now at like the 50 day, right? But like 2 weeks from now, like I really don't know, right? It seems like to be like a tough time frame to really like forecast. So that's why I do oftentimes try to avoid it. And when volatility is higher, just focus on like very very short or like the 2 months, just because I feel like that's where my confidence is really higher. in these types of tapes. Does that make sense? Yeah. I mean, it again, it's not easy, and especially when you're in like a lot of positions, or when your time frames are a little bit longer. I mean, the Q's correct. I mean, it's an official correction. The Q's dropped officially 10% off their high. So 10% in 3 days. I mean, that's like a very steep move, very quick. So, I mean, it's understandable. I mean, like the last couple days were hard, but what I find works for me is, a is it's like having some hedges, B, being in like the proper like time frame, and then like looking at like cash flow ideas, right? And then C is just really not trying to overreact. Like I I really like I have my stops. I have my targets. If it hits the stop, I get out. If it hits my target, I get out. And if I do end up missing, so like I try to hit my stops, but if I miss my stop on my option position, the thing I'm constantly reminding myself is like, okay, I missed my maybe like today was like a tougher day because everything gapped down so much. So say it gapped to your stop. Like at the end of the day, just you have to remind yourself that what what I paid, so the price paid for those contracts are your max loss, right? So you don't want to panic sell, but you also just you want to be at a spot where you're comfortable with the risk, right? So it's probably not a good tape to be like super sized, and like kind of going crazy like with speculation, like trying to hit a home run. Maybe you size down, take your risk down, right? Because the big moves are bigger, and you just want to be comfortable with like the amount of money you're putting into a trade. And like sometimes I like in a tape like this, I push my stops out to maybe like 70, even like 75%. And especially if I'm sizing down, right? If I'm taking like half the size I normally do, then I don't necessarily mind opening up like the risk on those contracts to maybe like 70 or 75% versus like the normal like 50 to 60%. All right. Any questions with that? I mean, like I feel like the spiders aren't even really worth talking about because it's basically it's all about tech. But I obviously you can see it's very similar. Qs though was where all the action's been. Um, and uh, what so like circling back to SoftBank, um, what's interesting about that? So I don't talk about Gamma very often. Um, yeah, so if we got down for there's definitely a few names that we've traded in the past that I want to revisit. So like Square was one. Square was absolutely amazing. I mean, like this stock was definitely one of like I feel like one of like the best we traded. I mean, like the move from like I think when we first got involved was what, like May or early June. So like this is one that we exited, and it's been on my radar for a while for a revisit. So this is one I've been looking at. Baba, another one, which was absolutely amazing the last couple of months. This has come back down to a big level. Right? So this is what I was looking at on Baba. Really nice looking pattern forming. So I have like a bunch of different ideas, of names I want to revisit. Just waiting for like the right prices. I'm waiting to see. I want to see like selling kind of exhaust itself. I don't want to step in front of like a freight train on some of these, especially like if we've made a lot of money on them. I don't want to like just jump back in just for the sake of doing it. So I kind of want to make sure that like the selling's exhausted. But um, yeah, there's definitely a few that I'm looking at, and what I think is kind of like a good strategy right now is like longer dated spreads, or also um, calendar spreads, right? So this is something like this market's like one that kind of sets up well for calendar spread ideas. Assuming you can kind of line the strike prices up and like the risk up, because uh, when implied volatility gets elevated, you see that acutely. You see that more acutely in the short-term options. So right now, especially with these names that don't have any like major catalysts coming up, you get expensive near-term options with no catalyst, and then can be like a nice opportunity to like sell those to like finance like longer-term positions like out through a catalyst. So if you can sell September and buy October, with like October being earnings season, some of these actually seem like really good setups. But I want to like make sure like the selling's exhausted and that we don't just keep like blitzing down through like some big levels. Yeah, Baba, Square, AMD is annoying, but I do think that that's one. If it gets down into the low 70s, I think that's one that we'll probably look at again. Shopify was one I had on my watch list. That's getting down into some big levels down here. I think if it can get down into the 100A, definitely one might I might start to look at. Um, Tesla, I was trying to like figure out if there's a calendar spread strategy that could work for the battery day, but I couldn't get the risk to line up. But that's actually one where I thought if like the option pricing made sense, I thought maybe like you could get like a Tesla calendar spread where you were to like sell 18th expiration, right, and then buy 25th expiration September on Tesla, because you have 18th expiration, which with no major catalyst, and the 25th expiration, so like the week after is when you have the battery day and kind of like a bigger event on the horizon, right? So um, I was looking at like the 390 or 400 calls just to see if I could line up like the risk, and they were still a little bit too expensive. Like those strategies were a little bit too expensive. So I'm kind of eyeing that because I thought that was like an interesting idea for a calendar spread, just because it does have a catalyst coming up. So that'll be one I'm keeping an eye on too. Qs? Um, yeah. I mean, I think like Rocket's just, I think, a victim of just bad timing more than anything. I thought the numbers were fantastic. It's kind of frustrating that it's pulled back as much as it has, just because I thought if it were to hold above like 25, 26, like it would kind of maintain this upper pattern. Then it got dragged back down into like the low 20s. That's one I've given more room. So obviously, like if you're in these December options with me, they're below that 50% normal stop level I use, and I've given this more room because we were able to roll twice on the way up. I do think like once we stabilize, like this is a name that should rebound sooner rather than later. I thought the numbers were excellent. It had a ton of momentum. Definitely a name that gets a lot of like attention from like retail traders. So I think it has a lot going for it once we do stabilize. And that's, part of what's playing into like the fact that I decided to hold on to it was with that we were able to roll really fast and take a lot of money out of it as it ran, and also the fact that it's December expiration, it gives us a pretty wide window. Even if it doesn't bounce back to like the mid 30s, those options should recover premium just because there's so much time value. So yeah, I think once the market stabilizes, I do think like a name like Rocket should be in a pretty good position to like bounce back quicker than others. We just kind of have to see. Hopefully, it can bounce back above 25, 26 quick, right? Reset like this higher range here. So, so this is why I'm so fixated on 25, 26. You can see like it was resistance, resistance, broke through, support, support, and then another run. So this is why I'm so fixated on this level, is because I want to see like this like reset, and then once that does, then we could. I actually like wrote about this in tonight's letter that's going out. But basically, I think once it resets, my plan will probably be to like roll those December options down into something closer to the money, but probably stick with like the December time frame. Yeah, yeah. I mean, I really do think it was just more a victim of bad timing. Um, just unfortunately, they reported earnings on the night where everything collapsed. So like Thursday, everything collapsed, and they had the unfortunate timing of reporting earnings like the night before. So it just, yeah, it was just I think more just a victim of bad timing. But now I want to see it stabilize and reset above like 25, 26, and then I think it should improve quick or quicker. Yeah. I'm kind of curious to know if Rocket was one of like the SoftBank names, because that had just Rocket had just extraordinary amounts of calls getting purchased day after day after day on it, um, and it kind of fit the mold. I mean, it's not like a tech name, but a new like a hot new IPO. I wonder if Rocket was one of like the SoftBank names among many others. I mean, going into earnings, the 46 strike calls on Rocket were priced in like $2. The next day they were worth 10 cents. So it just shows you how quickly the premium deflated. Which I don't know why they were pricing in that much to begin with, because normally when a stock gives preliminary guidance, the expectations are for a more muted move on earnings. So I actually wasn't even expecting that big of a move in general, like one way or the other, just because they'd already guided. It was a surprise, but also disappointing. I wasn't expecting that big of a move. Otherwise, I probably would have hedged it, obviously. Yeah. Yeah. So just quickly before we get into other things, the the SoftBank headline, right? So I'm sure you read about it, and um, Gamma hedging. Um, it like I don't use Gamma on a day to day basis, and it's just because I haven't found it like relevant to like my trading style. But what's interesting about what SoftBank has been doing is that it essentially like created uh, like this loop of just ultra bullish action, right? So like I guess like the easiest way for me to kind of describe it is like for um, well, what's like a good one there, and probably like Tesla. So what basically what would occur is they would buy the stock, right? They'd buy a significant stake of stock, and then they would buy a significant portion of calls, right? And what that does is it makes like the counterparty to those calls have to hedge out the shares, right? So um, if you're if you're just buying like a couple options or like 10 options or 20 options, then somebody on the other side of that could be like a retail investor, right? Or somebody who's like, it could be somebody that's just looking to sell those or covered, etc., right? But like if you're buying 2,000 if you're buying 5,000, right? Like the counterparty is either, somebody you've matched with, or it could be like a market maker. And in either scenario, if it's a market maker, right? And like somebody bought, so say like SoftBank bought like 5,000 calls on Tesla, and they bought the shares too. Then what the market maker does, who sold them those calls, is they have to hedge out their delta slash gamma exposure, because I mean they don't want to be short Tesla, right? If the stock is going to start ripping, they don't want to actually be short those calls. So what they do is they buy the stock as like a hedge against the calls they sold short, right? So what happened is, it's like, so SoftBank buys Tesla, right? They buy the stock, and that pushes the stock up, and then they buy calls, like a huge block of calls, and then because they bought a huge block of calls, the market maker has to buy Tesla stock, right? Because they don't want to actually be short those calls, or short like the stock, like delta or gamma wise. So then the stock goes up higher, and then people see the stock going higher, and they buy more calls, and then it's kind of like this loop of, like, people buy stock, buy calls, and then the people that are sold to calls have to buy more stock to hedge the calls they sold short, and it just keeps going and going and going and going, right? And what happens is that it just kind of like artificially, it like inflates like the move, and then once those are unwound, it leads to like these really nasty reversals, right? Because once the stock starts to actually crack, so when it finally does start to roll over, then basically like the dealers, or once those options expire, then like the dealers, so the market makers that bought stock to cover their calls, right? Then they're either not short the calls anymore, or if the stock rolls over, they can buy them back for cheaper, and then they don't actually want to be in the stock, so then they sell the stock, and then they sold the options and they sold the stock, and then it kind of goes the opposite way, right? So what you are noticing, and what we saw in a lot of like July and August, was like stocks that are just going like these parabolic runs with just like these epic amounts of calls, right? And people pile in and follow like the big blocks of calls, and it just keeps pushing and pushing and pushing, and it's like this loop of, I guess, what like smart money has started to understand is, like, if they can put enough risk into the option market, they can actually influence like their underlying equity position in their favor. So that's why this is gaining so much like attention right now, is because it's basically they're realizing that like SoftBanks and maybe some of these other smart funds that have a lot of money can actually like force stocks up in their favor, using options, and options at the moment are just like so. I mean, like, the interest in them is just exploding. I mean, with so many people um, trading now. I mean, the option market is like, the volume is just insane, and people are realizing like all the impact options can now have, where it's almost like the tail wagging the dog, right? And I think some people have maybe understood that in the past, but I think it's becoming much more common knowledge now that the disproportionate effects options can really have on stocks and momentum, etc. Yeah. Yeah, it's crazy, right? And I think, I mean, I guarantee you, SoftBank weren't the only people doing it. I think if there's a good idea out there in the street, and hedge funds catch wind of it, I mean, I think it's like one of those things that people will keep doing it until it doesn't work. So yeah, maybe SoftBank's getting all the attention, but I guarantee you they weren't the only people doing it, right? People kind of understanding how like the system works, and um, just kind of like using it to their advantage. So I mean, it's definitely interesting, and I mean, I guarantee you it's going to get a lot more people paying attention to what's going on in the option market, just because they see how much it's impacted like trading over the last few months. Yeah. Yep. Exactly. Yeah, it really it accelerates the move in both directions. I mean, it accelerates it on the upside, but also accelerates it on the downside. Um, Not to mention, I mean, a lot of the option activity has been in like really like short term stuff, and those in and of themselves are just like ultra risky. So it's like people are taking like all people are taking on like excessive leverage in like ultra risky short term contracts, and it's just leading to like this crazy action where I mean, you're just seeing like just remarkable moves in like a short period, and then I mean, we hadn't really seen like huge corrections up until the last few days, but now you can see like it's accelerating like the selling on the downside too. Yeah, I mean, it really, I mean, it really is like the tail wagging the dog in that sense. Yeah. So I want to talk about it quickly. I mean, I don't use Gamma on on a day to day basis when I'm trading. It's one of those option concepts that it's worth knowing about, and then maybe some of you that go a little bit more in depth into the Greeks for your trading style, you might utilize it more. It might be something that you, um, I think also too, like if you work for like a fund and you have like a bigger book, and you're like selling, if you're more of like a credit focused option trader, like like Gamma is probably going to play um, into your day to day activities a lot more frequently. But if you're just like a debit option trader, it's probably not going to come up as much. But it's something worth like knowing, right? Because it is an important concept of options, and whether or not you use it on a day-to-day basis probably depends on what your style is. But it was interesting, and it got so much attention this weekend. It's definitely something I wanted to like talk about. I mean, literally on Saturday morning, I was having my coffee, and like it was like Bloomberg, Wall Street Journal, Barron's, Market Watch. I mean, it was even like the New York Post. I mean, they even had like a section on it. I mean, it was literally every financial like news publication was talking about it this weekend. And I think they're still talking about it too. Just like just a big deal. But like you said, Mercy. I mean, they haven't necessarily made wise decisions the last year or two. So I don't know. I guess what kind of remains to be seen if this was a wise decision or not. Could be a lot of gains on paper, but they're not gains until you realize them. Yeah. Any questions? Um, there was a couple. So I actually a lot of what I just talked about was what I was going to go over um, in like the slides today. I kind of like jumped the gun on some of it, but just because we're in a role and like going over things. Um, but I really want to. I'll come back to like a couple stocks and like I want to talk about what like the VIX was doing. There were like again. I mean, there was so much has happened in the last week that I had a hard time like really figuring out like what I wanted to like focus on because like there was so much I kind of wanted to talk about. Um, so if I seem a little bit like more like touching on like a bunch of different things this time, it's just because there was like so much going on that I kind of wanted to like at least like highlight like a little bit of everything. Um, just kind of it's like kind of I don't want to say like jumping around because like I really do want to like spend time and like go over some things, but there was so many different topics and so many like big headlines that just I felt like I couldn't like zero in on just one idea. Sometimes sometimes it's just like we only have like one or two things, big developments, but this time it's just so much going on. So this is kind of what I was saying. So I jumped the gun on what I wanted to go over in these slides, but it's just like reiterating the idea of like the two and two, right? So I think this is if you if you find yourself kind of like struggling to figure out how you want to approach like the current market, so the current tape, especially option focused traders, like this is what I find works for me. So I call it the two and two, and it's again, I mean, it's very very short term. So um, 1 to 2 days, right? Like because there's just lower visibility. I do again like I don't know what like 2 weeks from now we'll have in store. But I do have like a pretty good suspicion. Like we closed on the low today. There does seem to be does seem to be a higher chance that we do have some sort of like dip again tomorrow. So again, lower visibility for like 2 weeks, but higher visibility maybe for like 1 to 2 days, right? So focusing on like very short term contracts like weeklies. I'm doing a lot of day trading, right? And also like 2 months. So, I'm looking at really really like say like top names that have come into like big levels. I'm focusing on maybe like recent winners that I have kind of like a good feel for how they move, and I'm watching those as they come into like big moving averages or important moving averages, etc. Right, and then what I want to do is I want slightly longer term swings. So that would be October, November, December at this point, and that's mostly to give myself enough time to let the trade develop, but also to like smooth out the higher relative implied volatility, right? So just basically, to like kind of like summarize it, it's just two and two. So very short and then like longer term. Um, also, I don't know if you were on the VTF on Friday afternoon, but this is a little bit of what I was talking about. Is that the implied volatility can be kind of tricky when you have this really sharp acceleration to the downside, because just a fundamental aspect of options is that higher volatility it just leads to higher option pricing. So yes, the market got hit very hard, but at the same time, call prices could also be going up too because the overall volatility. So the average trading range is expanding, the average volatility is expanding, so the pricing on both calls and puts are expanding, right? So this can be a little bit more challenging, especially if you're trying to time the absolute top or time the absolute bottom, right? Because you'll find that there are scenarios. So, like, say for instance, say for instance you bought the absolute low on a stock today, right? Say Tesla. So here's a good example. So say like the absolute low is 330. Say you bought a call on Tesla at the absolute low today, and tomorrow Tesla's up like 5, 6, 7 points, right? So it's bouncing, um, so it's moving in your favor. But what you'll notice is, say like tomorrow it's up 5, 6, 7 points. The next day it's up like two. Next day it's down two. Next day it's up five, right, etc. Basically, it's moving in your favor, but what you'll oftentimes see is that because the overall volatility on that stock is starting to contract again, so as it stabilizes, right, as it consolidates, and as the overall fear subsides a little bit, as people kind of feel like it's starting to like cool down, what you'll notice is that the price of your contracts are going to start to decrease as well. So you're going to start to see a contraction in the implied volatility. So you may have timed the bottom on Tesla absolutely perfectly, and it may be up like 10, 15 points from where you got in. But what you'll notice is that a lot of times you could see like the calls actually start to lose premium, and you might actually be down even though it's moved in your favor. And that's because the overall implied volatility is contracting because like the fear and the average trading range is starting to contract, right? So um, that is why a lot of times I like to say I want to wait for things to kind of stabilize. I want to wait for selling to exhaust because it's not like I'm not trying to like find the bottom because I'm watching to see like I'd love to like pick like a bottom or pick a top, but it's because of the way the option dynamic is where it's not always beneficial to be the absolute top tick. It's not always beneficial to be the absolute bottom because the option pricing might be too high at that point, and even if it moves in your favor and reverses, you might not actually capitalize as much as you would have had you just waited for like that first like 2, 3, 4 day consolidation to take place. Okay, um, I, and I'm sure like if you've been trading options for a little while, you kind of have like an idea of this in your mind, or you've seen it play out before. Maybe you've been involved in a trade where this has happened. But it's something like a really important point to drive home is that if you're trading equities, it's different because if you bought 100 shares at the low and it's up 10 points, then you made 10 points. But if you're trading options and you bought the absolute low, it doesn't just because the stock has rallied doesn't necessarily guarantee that you're going to be up on those options because there's more factors that play into the pricing, right? So, trying to time the top or time the bottom perfectly is not necessarily like in your best interest as like an option trader. So what I find works, right? So like if you are looking to like try to catch that reversal, right, and you are trying to do that, what I find is that in the money options are probably going to be the way you want to approach it. Okay, and that's mainly due to the fact that implied volatility is going to be the option prices are going to be less sensitive to dramatic shifts in implied volatility because when you're trading in the money options, most of the premium on those options is intrinsic, right? So implied volatility, it will impact it somewhat, but it's not going to impact the cost of those options as much as, say, at the money options or even more so out of the money options. Out of the money options are going to be most impacted by dramatic shifts in implied volatility because that's mostly what those options are, is like implied volatility and some time value. Whereas in the money options, they're going to have a higher delta. So if the stock moves, if you do catch that reversal and it moves in your favor, that higher delta is going to allow you to capitalize more. And also, if you do see implied volatility contraction, they're not going to get hit as hard because most of the premium of those contracts is due to intrinsic value, not implied volatility. Okay, does that idea make sense? It's I don't want to like deter people from like looking for like those reversals, but I think if you're gonna go about it, it's smart to go about it like a certain way. And I think if you're trying to like catch like a bottom, catch a top, especially something where the implied volatility is very high or maybe very elevated versus historical, you probably want to look at something that's a little bit more in the money. UVXY. Uh, in what sense, Mercy? The, yeah. So the issue, the issue that I find with these VIX instruments is that they are 90, maybe even 95% of the time just like lousy trading instruments, lousy vehicles to make money, because it's you really need a dramatic like uptick in fear, and a sustained uptick in fear to really like pay those trades. So I just I I basically I like to like sit in some for like the off chance that you get it, but I feel like on a day to day basis, like it's really difficult to manage UVXY options. It's difficult to I feel like it's difficult to make sustained money in UVXY options. That's why like I always try to unload into strength, um, and you know I will say that like I wouldn't I don't want to be in like in the money options on the VIX or the UVXY, especially like the double triple leverage because like the rate of decay is not in your favor. Uh, so it's just yeah they're just poor trading vehicles. I mean they're good in like those like odd scenarios where like everything goes crazy like in March, right? But most of the time they're just really really tough to make like consistent money in. I you know if I had my choice of the three SPY, Q, or VIX options as a hedge, I would put the VIX at the bottom of the list every single time. I think it's the absolute worst hedge you could have. Well, to be honest, like the best hedge for a position is like option is are puts on that specific stock. So if I wanted a hedge, you know, if I'm sitting in like three if I'm sitting in three stocks, say like Apple, Amazon, and Facebook, the best hedge would be puts on Apple, Amazon, and Facebook, right? Because those are going to those are going to react to like the movement in the stock much more uh, much more um, sharply than the Qs would. So if you're sitting in, so that's why I say like if you're sitting in like 1 to 5 positions, like I think, and you want a hedge, then the best way to like go about it is to just look at hedges on those individual names. If you're sitting in multiple positions, say like 10, 15, 20, then you could look at yeah, say like so if you're more tech based, so Qs, if you're more broad based, SPY, if you have a lot of energy exposure, you could look at the XLE. If you have a lot of semi exposure, you could look at the SMH, you know? So it really kind of comes down to what the composition of your positions are. But I really feel like if you're in like less than 5 names, the best way to hedge those 5 names would be puts on those 5 names. So if you're an Apple, Apple puts. If you're an Amazon, Amazon puts. Those are going to be your best bets for hedges. Yeah, yeah. I mean, if you're in a lot of different names, then that's where you get into like the SPY, you get into the Qs. But from just like a when you like narrow it down to like a hedging scenario, yeah, the VIX the VIX and the UVXY, I again I mean like if I had my choice, like that would be lowest on my list every single time because they're really bad hedging vehicles. They're good for like the odd scenario where everything goes crazy, but on like a day to day, week to week, month to month basis, they're just really awful hedging vehicles. Yeah, yeah. It's just it's just it's just like the you know I mean like it, I think VIX itself is just it's a tougher instrument to really to trade. the actual underlying VIX. It's just tough. Like fear can be unpredictable and hard to kind of get a handle on. Um, so again, kind of like summarizing, if you if you have the ability to wait, and as long as the stock isn't moving like materially from your entrance, right? So like in like the scenario with like Square, what I was talking about before, or like on the chart, it's like as long as Square is just kind of hanging around the 50-day, then it probably benefits me more to wait and let the option implied volatility contract before getting into like a swing trade, versus trying to like get in like the first day it bounces, right? So if you see me like really trying to be patient, a lot of times this is one of the main reasons why. Um, it's just because I I don't want to I don't want to be caught like paying up for options only to see like it move in my favor, but the premiums contract due to the high implied volatility. And then um, like the 2 and 2 strategy. So like that kind of lines up. It's basically the same thinking, right? So longer term, so like 2 months out. I mean, those are going to be those are going to have a lower relative implied volatility just generally, and then like the very 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 short term. So like my weekly contracts and like my 1 to 2 day trades. Those I'm managing so closely that I'm not, I mean if I'm doing it the right way, then I shouldn't be too susceptible to like those dramatic changes in implied volatility because I'm basically just focused on them. Like I have a close eye, and I shouldn't, if I'm doing it right, I shouldn't be too caught off guard by like a drop in implied volatility because I'm keeping an eye on those contracts because like they're basically just day trades. And then lastly, just calendar spreads. So um, these are just a really good way to capitalize on the higher implied volatility, especially if you have the expectations that um, volatility is going to quiet down, or maybe if there's some bigger catalyst coming up, right? And you could design a strategy where you're selling expensive near-term premium and buying lesser or relatively less expensive further out premium, and you get a catalyst on top of it, right? So um, this is, if I could summarize my trading strategy for volatile environments in one slide, this would be it. Like this is really like the nuts and bolts of what I really try to focus on when volatility is higher from like an option trading perspective. All right. Any questions? Was there anything, any charts you guys want to go over? Any trades you want to go over? This was I had a lot of like like a lot of like topics I wanted to go, like touch on, and I think I did most of them. I guess now it's just like, are there any like trades you want to break down? Um, I I apologize for not having the earnings on the radar video up. Just like the new mic schedule is kind of like thrown off my whole routine. So um, I I normally record those on Friday, and then I was on the mic and I couldn't record it during the middle of the day. And then once I get to a certain point, then compliance won't approve it, and then it's like this whole cycle. So it's just like, yeah, I just once I get like a new routine in going here with like the mic. I can kind of I can update that. Silver. Let's see. Let's give me a sec. I need a new charting software. I don't use free stock charts like during the day. It's only I use it just to like draw charts. I definitely need to get a new one because I feel like it's been having more issues recently. So yeah, I mean I feel like silver and gold they're both hanging in. Um, I compared to other things, I feel like the action's actually better, so more bullish. I mean, I don't like the fact that it is below the 8 and the 20 here. So I'm not a huge fan of that, but from like just like a strictly technical perspective, it's kind of hanging above support. So it's still above, it's still in like this higher base. I mean, I'd prefer for it to get back above like these couple moving averages here. Um, but overall, I feel like it's still hanging around, still hanging around. Also, I thought that the jobs report on Friday should have been bigger catalysts because you had unemployment going down, right? Unemployment going down, basically the Fed maintaining that they're not even thinking about raising rates. So you could have inflation tick up. So I don't know. I mean, I think also like gold and silver, they benefit from like defensive positioning. The only thing I could think of is maybe like, people are just taking money off of anything that's been up a lot over the last couple of months, right? So anything Momo kind of paused or pulled back. So other than that, though, I mean, I feel like silver's hanging in pretty nicely. I'm not going to let it like fall apart, but it is hanging. It's holding where it needs to. Again, if you look at a longer term, right? So it basically ripped to close the gap from 2013, right? And then what you can see is if it resets above like this long term, so like 2011, 12, 13 support range, then you're probably looking at like low low 30s. So that's kind of why I decided with the call spread I did. So like there was the 25 to 32. And the reason why is because like kind of like the top of this like defined range. So from like 25 area is like up to like 32, 33. So overall, I mean, I feel like silver is hanging in where it needs to, and I still think that there's a lot of upside potential. But right now, yeah, I mean, it's mostly just kind of like hanging out, consolidating, forming a higher base. I would like to see it get above these moving averages. So in the near term, it'd be nice if it could get back above, say, like 25.50, 25.75 or so. So it doesn't need that big of a bounce, but if it can just get back above these two, I'd be a little bit more, could sleep better at night. Yeah, and then gold is basically same, right? Just holding above, holding a higher base. It actually hit the 50-day today, bounced off of it, so I think both look okay. Both, I don't know if some of it had to do with just profit taking because they had such great runs in June, July, and August. But yeah, I think both are holding where they need to, and I think we'll have a pretty good idea when they're going to get ready to go because I'm sure like there'll be a lot of call buying. I'm sure like they'll both like wake up and start to like put together a couple days in a row. So I think when they're about to take off, we'll know. Gonna add more size into some stuff. Yeah, yeah, but I mean, so far they're holding in. It's more than you can say about a lot of other things. There's some serious damage that was done last 3 days, 4 days. A lot of momentum stocks. Yeah. Like any questions? It's something unrelated to what we talked about. I feel like I was like I think I slept too much this weekend because I just felt like I could not wake up today. I need to like get less sleep tonight. Butterfly spreads? Yeah. On which ones? Qs? Uh, the ones I closed this morning right off the open. Those were just standard put spreads. Or are you talking about the ones I added earlier last week? Um, yeah, put flies. It's put put flies and actually I guess call flies in general. Um, they really are. They can be tougher. Um, they, there's a lot that can go wrong. And you kind of need to like you basically need to exit early or exit late. That's like the way I anybody ever asks me, I say like you have to exit early or wait until like the last minute because like the way like the structure of the flies, it's um, like you kind of have to like take the money when they move in your favor immediately, which is what I did with the Qs. Or you have to like wait until all of like the time value is sucked out of the contracts, and then you can kind of more maximize your potential. But when things are going nuts in the market, right? When the Qs are dropping like 10% in 3 days, it's really tough to like sit on options that are in the money for what like 2 weeks. When they basically double in a couple days, I don't have the comfort to like sit on those, especially like the Qs, right? Because I feel like they always just snap back so fast. Um, so I basically what I do is like when it moves in my favor, when especially for like flies, I'm just taking money. So I don't know what the exact return was in those. I think it was like 80, something of like 80, 85% return range. Um, if I had if I had held it, if I had held it, I probably could have gotten like another. I probably could have made even more today because it moved closer to like the midpoint of that fly. Um, it's just I don't have like the desire or the patience to sit in like the Qs once it moves like sharply into the money in my favor and the options are like short term. Yeah. Well, that's why I always try to line the midpoint up with. Um, I mean, it's not necessarily like a set holding period. It's only like whether the trade moves in my favor early or late, because that really is going to determine whether like I want to like continue to sit in it. Um, so it was just, I mean, had the market not rolled over so sharply last week, I probably would have been sitting in the contract still, because it really all just depends on like when it moves. So it's not like a set holding period, but um, versus like say like normal contracts. Um, I'd say Yeah, I think it would be I think it would be a sustained break. Um, so I think basically two things. So I think if we lose, I think if we lose the 50 day and really continue sharply lower, then I think the first bounce is probably going to be shortable. Um, and then after that, I mean, it's really going to be like, how do we respond, you know? So I think we're at the point where the rubber band could break if we don't bounce soon. And if the rubber band breaks, then I think then you have to really um, then you really have to like adjust your bias versus like strictly bull. You know, like I think we're at the point where if we start to really go from here, then a lot of bull scenarios could be in jeopardy, and that could like really challenge like the next couple months worth of like action. So I think if we don't bounce like immediately, as in like the next day or two, and if we continue to sink at a faster rate from here, then I think that's really going to put me into more like the 60-40, 50-50 camp. I think though longer term positions are still going to be bullish biased, but what we'll do is probably be like shorter term positions looking for downside, longer term positions looking for upside. But I think if we don't bounce immediately, then like the mix of trade ideas is going to shift real quick more to like 50-50. But again, you know, I'm not going to like just go about shorting stuff like 3-4 days down in a row. I mean, still want like quality short setups, or you know, some fundamental news. But I don't know if there's going to be anything fundamental right now. I don't know what fundamentally would disrupt it. We have the election coming up, but not for 2 months. We'll see. We never know. Yeah, it's just such a great trend. Yep. I mean, you literally can't draw it up any better. So it's like goes, bends, and then breaks. So now we're at the point where the rubber band is stretched almost to the point of snapping, and we kind of need to reverse, otherwise, um, it could get pretty ugly. Momentum works both ways, right? I mean, momentum is amazing when we're rallying, but also, I mean, March showed us exactly what it could be like on the downside. I think you just need to be very specific with your entrances, and I think you need to be lower risk size. So, um, you know, I don't think it's a bad idea to take your size down. So whether that's 75% of normal, 50% of normal, I think I think right now it's not a bad idea to be a little bit lower size just until things stabilize a little bit, or maybe until you get like a little bit better handle on the overall action, right? But that's usually what I do is just size down a bit, um, and then once I can like get a better feel for what my risk needs to be, then I can kind of get back into like my normal size. But I no, I definitely do open new trades. But the way I can control it is just by keeping my size a little bit lower. Does that make sense? Because to be honest, I mean, there's a lot of opportunity right now. Stocks are flying around, so I want to try to make money, but I also realize that we have a lot more overnight risk now. I mean, today we opened down what? Q's opened down like 3%, 2.5%. So you have to acknowledge that there's more overnight risk. There's more two-way action, so things can actually go down. And there's a chance that you might not be able to get out at the exact point you want to. So um, I want to trade because I think there's a lot of opportunities to make money, but I also realize that my overall risk is higher, so I need to have lower size or smaller size. Yeah. Make sense? Cool. Um, all right. Well, maybe that's a good time or a good place to take a break or wrap it up. Take a break. Jeez. Yeah. Yeah. Cool. No, I on it. So when I say this, I really mean it. Like if you ever have any questions or if there's something you want to run by me, like some idea, some trade, like I really am I really don't want you to feel uncomfortable reaching out. Like that's why I'm here. That's why we get together every 2 weeks. Like it's basically just for me to be able to help whichever way I can. So if you have some question and you want to reach out, like shoot me an email during the week. I try to get back as fast as possible. If you don't have my email, you can just reach out to whoever your contact is on the T3 team. They always forward them to me. Um, but I mean, I think volatility will at least be here, at least in the near term. So I think it's just like a new maybe temporary reality we have to adjust for. Um, and that doesn't mean that we can't make money. But what was working for June, July, August, it might not be like that exact same market. So kind of just have to adapt, have to just maneuver a little bit. It was like last week. Last week, there were a couple painful days, but I think now that we're in a little better spot, a little bit leaner, size down a little bit, maneuver a little bit quicker, and I think that there's going to be a lot of like good opportunities. So whether that's like day trading or like positioning for some like longer term stuff, it's just I think this is going to create a lot of opportunities. So um, should be a lot going on the next week, 2 weeks, 3 weeks. I mean, I think we're setting up for a busy September. All right. All right, guys. Yeah, well, have a wonderful night. Again, please don't hesitate to reach out. Best of luck trading. Let's hope for some good earnings. Let's hope for some good news, and we'll see how the week goes. All right. So again, have a great night, and I'll talk to you guys probably tomorrow because most of you I know are on the VTF. So see you in the morning. All right. Have a good one. Stay safe.